following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on 94.1 FM WNBU, as well as cable TV 10 in New Bern. We welcome all our viewers and listeners out there. We also have people that watch the video and listen to the audio from our website. We welcome you as well from www.dlblain.com. As always, we welcome your comments or questions on the show. We love to hear from our viewers and listeners what's on your mind, the topics you'd like us to cover. So you can reach us by phone. The number is 252-633-0107. You can email us directly here at the show, allthingsmoney@dlblain.com. And of course, you can always go to the website, dlblain.com, and hit the big Contact Us button. Okay, well, getting over a little bit of a cold here. I hope it's not too bad, that you'll bear with me today. We've got a lot of good topics to cover, so I want to get right into it. The first one, there was an interesting article in Investment News. It's an industry paper that I read. And I've been talking about this the past several months or even years. As most of you know, I'm not a fan at all of annuities, especially variable annuities. I think that they're one of the most abused and missold things out there by advisors. As you know, we are a fee-only advisory practice, so we don't sell any products whatsoever. People pay us for our advice. And so we're free to say that annuities are generally a bad deal for the consumer, but yet they're constantly sold by brokers out there. They pay a nice commission to most folks, and they're part of the problem is that the guarantee, that word guarantee, is floated out there and really hooks people in, and people don't understand it. Any investment that has a book this thick that you're given when you invest in it is way too complicated, way too complex, and you should run away, frankly. And that's what annuities are. You know, a simple, with a stock or simple exchange-traded fund or mutual fund, there are some disclosures required with funds, but nowhere near the ridiculous amount with annuities. So we generally recommend people stay away from them. And what we're seeing is in the industry, we're seeing all sorts of problems in the industry. And it really strikes me as odd that you have certain people that just rail on the federal government for Social Security, and it's a Ponzi scheme, and they're taking from one bucket and giving to the other, and they don't have the money and things like that, and they rail on that. And then on the other hand, they go out and they buy an annuity. And what you got to realize is, what is an annuity? And you are trading your money, you're giving your money. Say you've accumulated $1 million, you give it to an insurance company in return for some sort of guarantee. Now with a variable annuity, there's some sort of guarantee, and in theory the thing grows, and at some point you annuitize it. And at that point you trade your lump sum for a stream of income that, as you've probably heard the commercials, you can't outlive. Well, that's great, but just think about it. You are putting all your money, your faith, into this guarantee of the insurance company. And so what we're seeing, number one, is that these companies have way, way overpromised. By the way, we see the same thing in long-term care. We'll try to stick to annuities today. But putting way too much emphasis on this guarantee. So the companies that invest, the insurance companies, they have the same investments that you and I have available to invest in, and they've overpromised, and so companies are getting out of the business, or we've seen recently they've been announcing cutbacks in these guarantees. They just simply are overpromising, and when they build in their assumptions of this magical 10% stock return, 7% bond return that we have seen the past 30, 40 years, say, oh yeah, we can easily guarantee 4, 5, 6% a year and charge people, a bundle of money. Well, what we're seeing, as you all know, that the returns are nowhere near that anymore, especially in the fixed income industry, which is generally how they would take these annuities. They would take it and they would attempt to what they call immunize your liability, and they would look at how old a person was, and they would invest in bonds, a lot of it in bonds that would mature over that life expectancy. So, for example, if someone annuitized their investment and they were expected to live 30 years, they would take that lump sum, invest it for 30 years, at 4% or whatever it is, 4%, and pay the annuitant, say, 3.5%. And so they'd make a profit on that spread. Well, with the rates the way they are, who wants to lock in a 1%, annuity value? Not a lot of people. So we're seeing the companies continually cut the guarantees and things like that. So anyway, back to the specific article, the highlight is Pru fee hike, another nail in VA coffin. And Pru stands for Prudential. And I'll just paraphrase some of it here, but it says, rising fees for variable annuities at Prudential are making some financial advisors and broker-dealers question the value proposition for VAs. We've been questioning them since they came out. They're just now figuring it. That the mortality expense fee, they're raising the mortality expense fee, which is the insurance component of annuity. And if you compare the mortality and expense fee of an annuity versus the mortality and expense fee of a life insurance policy, a good high-quality term policy, you'll see there's no comparison. So if you need some sort of insurance, which annuity is an insurance product, go buy some decent term insurance. Anyway, so it says that will bring the mortality and expense fees to 145 basis points. That's 1.45%. That's way off the chart of expense for insurance. And then when you look at the all-in expense, so you've got the mortality expense, which is the insurance component. Then you have these riders and guarantee fees that you have, and then you have the underlying expense fees. And so what they're saying is 4%. The fees on this protective life policy are approaching 4%. That's unbelievable. They interviewed some advisor. He says, you have to look at whether the cost is going to be prohibitive. 4%? Prohibitive? Yeah, I think so. It's getting to the point where fees are outweighing the benefits and where you have to look elsewhere. Look, here's a news flash. It's been that way for a long, long time. And he says, you're almost over 4%, and in my opinion, that's pretty high. Well, you're absolutely right. 4% is way, way too high. Well, we're coming up on our first break here. When we come back, we'll continue talking a little bit about what's going on in the annuity world and how you can stay away from it. So for All Things Money, I'm your host, David Blain.